Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Dan Chetrit of Snowdon Partners. Nicholas, what was a takeaway you had from our conversation with Dan?
Another great conversation. It really is a privilege for us to be able to spend time with people like Dan and getting master classes like this on a weekly basis, as we do here on the Minds Capital podcast. So it's really a blessing. In this particular conversation, one nugget that stood out to me was how he talks about the recap they had done of their first deal. And so they had grown substantially, done a really good job with this. And as a sponsor or as a searcher, as they were with their first deal, you're now in the money. And so that means for every dollar you increase in value or for every dollar that you pay out, your carry, if it's at 30%, which was the case for them, you get 30 cents on the dollar. And you can use that in a recap to take out some shareholders. And in their case, they had recapped with a loan, taken out a few shareholders, and then made their carry into ownership effectively. I think the mechanisms for this is a little bit different in the search world versus independent sponsor deals, but nonetheless, the concept is the same, which is if you're able to pay off the debt, you're able to pay back the investor plus their 8% pref, now you effectively own 30% of the business, or 20%, which is perhaps more common as the carry. Okay, so what can you do with that? Well, effectively you own 20%. So that means if you can take out 30-40% of the investors, your 20% will effectively creep up towards the 50% mark and maybe up to 51%, at which point you're now the biggest shareholder. And that is what they did. And he walks us through the math much better than I did here. But it changes the dynamics. They had another 5 years with that company before they recapped it a second time. They had outstanding returns on this journey. And it was just interesting how they used that first recap to take majority control, change the ownership dynamics, and really be able to streamline things, and also to start building a portfolio of other assets, which was a big goal of theirs. So that particular math exercise we did with him there, you don't hear about it too often because usually an exit means a full exit for everyone, but it doesn't have to be. You can take out shareholders, and even if you had only carry and no initial investment, you can, for a well-performing deal, position yourself to get majority control if you kind of play it out correctly. So that was super interesting.
That was my favorite part of the episode too, Nicholas, and I applaud you for pushing him on the exact mechanic of how they executed all of this. From my orientation in Searchland, I was really interested to hear how a searcher could become an independent sponsor in the same deal, not do a search deal, exit the search deal, and then go and do another deal as an independent sponsor, but actually with the same first search acquisition, continue holding that business, but recap everybody and change your own ownership structure. There's also some really interesting sort of plot around why they did that. It was a travel business effectively, and it had performed very, very well, but then COVID hit. And so they knew that they weren't going to have a great opportunity to grow that business in the next 2 or 3 years. So this mechanism allowed them to recap out the investors who wanted off the bus, but had done very well. I think he talked about a 5x MOIC at that point for those investors. Keep the ones in who wanted to stay in, understanding that they would then control the business and hold on to it and kind of maintain it for a couple of years while waiting for the travel market to come back. And instead of sitting on their hands and waiting, they would go off and do other deals. And so this is also just sort of qualitatively how they went from, single business focused searchers to portfolio of business owner independent sponsors, all with the vehicle of the underlying search business kind of facilitating that. Really an interesting evolution and great detail there. So I think it'll be actually most interesting to traditional searchers to hear that bit. Max, did you have a takeaway from our conversation with Dan?
I did. I thought it was a fantastic episode. And I also enjoyed hearing about the recapitalization and the transition from traditional search to independent sponsor. That's definitely valuable and I think applicable to many of the searchers that are out there having good success and looking for a way to hold on to their companies a bit longer. I enjoyed as well hearing Dan talk about pricing and post-mortem analysis, which is a thing that we started doing at LCS probably 4 or 5 years ago. And it's super important. It's, pricing has obviously been a great lever for, increasing EBITDA and dropping cash flow to the bottom line. I think I agree. It's often one of the best and easiest levers, maybe not easiest, but it's one of the most obvious and best levers for a lot of businesses that are family owned that have been sort of just humming along with the same or similar pricing for a long time. I think that pricing has gotten potentially a little more credit than it's due in the last 5 years because it's been an environment where everybody's raising prices and we've had inflation and businesses have had cover for raising prices. And I think that cover is gone now. And I think the next 3 or so years it's going to be really tough to continue to raise prices on the consumer. I think there'll be edge cases where you have pricing power in certain markets and you can do that. But I think overall the consumer's tired. They're, the cost of living has just increased dramatically. Credit card interest rates are high. Credit card delinquency rates are high. So I think we've got to be careful just in general as business owners thinking about pricing going forward. I think you've really got to focus on differentiation and value for customers in this market right now. So I think while I agree pricing has been a fantastic tool and way to grow businesses in recent history, I think it's going to become a lot more challenging in the next few years. But the post-mortem element to this is super interesting. So I was saying that we started doing this at LCS about 4 or 5 years ago. And that's just to dissect what you're doing, whether that's a project or in Dan's case, they were dissecting the trips that they were taking these folks on, what worked, what didn't work, how many hours were spent on this, what was your cost. When you drill down and really look at how you performed, and I think more about sort of project-based work, when you really drill down and it's tedious and it's not fun, and sometimes you don't really like the answer. So I think a lot of folks and managers are not inclined to do this level of analysis because the answer a lot of times is, hey, we didn't do a good job on this and we didn't really make money or we made very little money. But it's so important to dive in and then figure out, well, why? What went wrong? What could we have done differently? And then we kind of come back to pricing. Did we just price it too low? And then maybe the pricing on the next one is a bit higher, but then you have justification for that client on this is why we have to increase the price on this project for you this next time. And if you can get a pricing increase through, oftentimes you just have to justify it.
Great. Well, before we get to our interview with Dan, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about 1 commitment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us via our website, mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form on our website for investors. So if you are or can become an accredited investor, fill out that form to be kept in the loop on future raises. That, again, is mindscapital.co. And here is the Minds Capital podcast interview with Dan Chetrit of Snowdon Partners. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com. Dan Chetrit of Snowdon Partners is based in Montreal. Dan and his partner Leroy started out as a traditional search fund. Their shift to the independent sponsor model occurred in 2020 when they recapitalized their first portfolio company just days before COVID, a travel company. That recap not only secured a good win for the LPs, but it also allowed Dan and Leroy to remove the full-time attention clause that had hampered their ability to build a portfolio. Today, they have 6 platforms, including that initial deal in the travel sector, which has returned a 10.5x MOIC after 2 successful recaps. Dan, welcome to the Minds Capital podcast.
Pleasure to be here, Will. And Nicholas, thanks for having me.
So Dan, many search fund operators, traditional search funders, become search investors or full-time investors after their success in search, but instead you went the independent sponsor route. Why?
Both are really exciting paths. And in truth, not through any deliberate effort of our own, but we ended up investing in a number of search funds in the years following the first recap. But the strategy in terms of building out a portfolio of concentrated bets, ones in which we thought we could drive operational value creation, really was the main attraction for us. And the reason for that is we felt that there were a number of operating initiatives that drove the MOIC in our original search fund deal, which were pretty clearly identified either in the due diligence process or in the first few months post-closing. And what followed is, as anybody who's operated knows, a really difficult day in and day out grind of being a CEO of a small business. But what we realized was we're not that great as operators. And if we could partner with a professional CEO in each of the subsequent businesses, perhaps we might be able to replicate some of these outcomes by staying close to the assets, being very active owners, and deploying more capital at scale than doing individual smaller checks, which unless you're an institutional investor in the search fund space, is typically what you're going to have. So that made it very clear for us what the right path for the next chapter of Snowdon would be. And that's what we've executed over the last 5 years.
So it was kind of a case of sweet spot. You wanted to bring to bear the operational chops that you'd earned, not too operationally intense, so you weren't going to be running the businesses yourselves. And at the same time, the ability to deploy capital into serious chunks as opposed to smaller bets across a wider portfolio, which is what a search investor might look like.
That's right. And it's not that passive. We spend, especially in the first few months post-closing, we're spending a lot of time with these companies and helping them build out infrastructure, build out teams. We spend a lot of our time recruiting. But over time, as the asset matures and as the team starts to gel, yes, it does become less time intensive. And so we don't have capacity to have, 12, 15 portfolio companies. It has to be a concentrated strategy for that reason.
Dan, I think we should hear about the travel story. I think that'll set the stage for subsequent questions. You're saying that you guys don't make the best operators. Not sure that this story will show that. It might show just the opposite. But let's hear that case study and go from there.
Sure. So we bought a direct-to-consumer travel business, which is not a typical search fund target, but it had a number of characteristics that made it attractive to us. And so I can rattle off a bunch of features, but in short, the unit economics of the business are really attractive, and I'll describe a little bit more about what that means. It benefits from quite a bit of revenue visibility. It's not recurring. It's not quite to that level of visibility, but the customers, if you serve them well, tend to repeat. And so the repeat rate is quite high. The margin profile that you're able to generate off a travel business was counterintuitive to us at first, but it comes from the fact that you're bundling a variety of services together and delivering them at a price point that seem very appealing to a customer. And so with all those attributes, negative working capital, asset-light business, all of those features came together and led us to concluding that was the right starting off point. It was a relatively small business and had a number of, we've always done things this way type of mindset. It also bears mentioning that this company focused on a very specific niche within from a customer demographic standpoint, and that's French Canadian retirees. So the original platform is called Incursion Voyage. It did not have an English button on the website and basically served Francophone retirees looking to travel abroad and to do so in an escorted group tour fashion. So we filled a coach bus in places like Europe and Asia and elsewhere where people are quite happy to delegate the planning to a tour company. And we offer a scheduled set of departures customers can choose from, and they can't really change much about the trip. If they don't want to do an activity on a specific day, they can opt out, obviously, but there's no changing day 5 or 7 based on your preferences. It's kind of take it or leave it the way we build it. And that business had run a certain way for 25 years prior to our arrival. And the most meaningful transformation, we changed a lot of things in the business, but the most meaningful transformation that we pursued was the customer acquisition funnel. And it was born from the realization that the traditional marketing mix, so radio, newspaper ads, and local TV ad spots, was not measurable and therefore was difficult to assign an ROI to. And so we pivoted entirely to digital marketing initiatives. And that required a few infrastructure layer type of investments. So we had to deploy a new ERP system that could capture upmarket funnel statistics from the web forms. It required us building out a team that understood how to deploy digital marketing ads, which your traditional marketing mix team had very different strengths and reflexes, and it required us to test a number of different platforms. And so we found success on Facebook, which if you think about a retiree, how do they spend their time? A lot of them are, following friends and family on Facebook with the morning coffee and a beautiful ad about travel pops up. And so that becomes a really attractive segment. And we did this in 2015, right around 2015, 2016. So this was a time when that channel was quite attractive from a lead gen standpoint. We also did it in one of the local newspapers had migrated from print to fully digital. And so they had a tablet-based experience, and we were able to run ads on that tablet app and target the customers that we were looking for. And so the punchline is that very quickly we were hitting almost half of the target demographic in Quebec. And so, there's a real question about whether the half that we are targeting is the right half of the target demo, but certainly half of the people in that age bracket don't have the means to travel internationally. And so we quickly concluded that we needed a bigger pond to fish in, so to speak. And so M&A became a really logical next step to expand the serviceable addressable market. And there are a number of reasons why M&A makes sense, but the primary one is this is a fixed cost business. There's fixed costs at the tour level, the coach, the guide, the driver, et cetera. And there are also fixed costs at the operating level. And so if you're going to expand geographically and expand linguistically, because the English Canadian market is where we were trying to expand to, it made sense to do so through M&A. So we did an acquisition. We ran the same digital marketing transformation playbook, in addition to a number of other initiatives like expanding margins and pricing and all this kind of good stuff. And we had built it up to a scale where it was quite attractive from a MOIC standpoint, but we knew we still had a lot of runway in terms of building the business. And so that's what led to the first recap discussion. We met with our investors. They were very supportive of the idea. We met with lenders who were also supportive of the idea. And it came to a place where, we could generate a great MOIC. It was financeable. And we could convert our carry, which we rolled 100% of it into the business, into a controlling stake in the business. And so at that point, we had economic alignment. And to your earlier comment in the introductory remarks, if you have economic alignment, you no longer need a clause in an LP agreement that says your full-time and attention is required. Because if there's an issue, the majority shareholder is certainly going to have incentive to take a look at that. So that's kind of what led us into the next chapter. Of course, we didn't foresee the COVID pandemic, and we could probably do a whole podcast about just that chapter. But we, there's some gray hair and some lost sleep as a result of that. But we knew we had survived the emergency landing. We had to downsize the team. We had enough of a runway that we thought we could make it to the other side of things, which we did. And so the ultimate pursuit was, how do we replicate this kind of outcome, but on a serial basis where we can scale it up, because it doesn't scale well if you have to be the CEO and run the full cycle 5-6 years or however long that takes.
And so, Dan, when you're making the decision to do the recap and deciding to recap out your existing investors to then own the entire business and allow you to essentially turn your attention to building a portfolio, why, correct me if I get any of that wrong, why not devote yourselves just to continuing to grow this single business, since some of the benefits of your time in that market were probably starting to compound? You'd already seen a lot of success, but that was bound to, at least the conventional wisdom would be that would only accelerate. The market that much better now, your network of small operators that you can acquire, et cetera, is all the tricks, your operational tricks that you'd learn, the digital marketing best practices, and on and on and on. Why not double and triple down on that single asset?
Yeah, so great question. And I guess the only thing I'll correct is we didn't buy 100% of the business. Our carry was enough to get us into a controlling position, but many of our investors ended up rolling equity alongside us in a minority shareholder capacity. So to the question about why not just spend all of our time in the travel space, it's a space we still believe in, and we still continue to invest a lot of time pursuing opportunities in. The reality is that our target demo, which is, call it 50 plus, but on average is in the mid 60s. And keep in mind also, we have a Canadian lens. So most of the revenue is driven by Canadian consumers. The Canadian government at the time was being very restrictive about international travel. And our target demo was probably one of the last to recover. Because if you're in your 20s and you want to travel, getting a COVID test when you need to come back to Canada is not that big a deal. Somebody in their 60s or maybe pushing 70 is probably going to wait and see how this COVID thing plays out. And so we knew that our business was going to be among the last to recover. And so the mission was make sure we keep the lights on, cover payroll, cover rent, all those types of things. And the Canadian government was super generous in terms of aid programs for businesses that were deeply affected by COVID like ours. But we knew it was going to be a long pause. And so it felt like a waste, honestly, to spend 2 years or potentially even 3 years sitting around waiting for the customer base to be comfortable enough to travel again. And so we knew what the 3-4 levers that we needed to stay focused on were in the travel platform. We delegated the day-to-day management of that business to someone who's been with us for a very long time, and he's now the CEO of that business. And we share an office, so it's not like we're completely disjointed. We just, it made sense to deploy our brain cells elsewhere for the 2 to 3 year wait.
Sure.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Enzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out enzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@enzotechnologies.com. Having acquired Enzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@enzotechnologies.com.
Could you walk us through the math on how you went from being a traditional search fund and then through one recap had majority control in the deal? Could you just be more detailed on that?
Yeah. So we basically, in a nutshell, we're able to drive almost a 5 times gross MOIC on that first recap. And so the way that came to being was when you're doing this gross versus net math, the net MOIC to LPs was just shy of 4 times. So that shrinkage, if you will, is the carry. Now, if that becomes equity in your equity box, you have this debt to enterprise value, and the enterprise value doesn't have to be, you can use the equity from the carry that's rolled, plus the rolled equity from your minority co-investors, or in this case, the LPs, and then add to that the debt that the bank was willing to provide to satisfy the sources and uses of funds. And so it was very much like a triangulation exercise. Is this going to be an attractive enough MOIC? We thought it was. Is this financeable? It was. And, is our rolled equity stake going to be meaningful? And it turned into a controlling stake. So that's kind of how the math worked out. In terms of funded debt to EBITDA, I want to say we were like at 3 times or 3.5 times leverage. So it was certainly a high leverage level for a business that eventually went into COVID, right? But at the time, it didn't feel crazy in terms of leverage for a business that we'd owned and run for multiple years. And keep in mind, in the travel business, you have forward visibility. So you have the next 12 months of revenue. You've got line of sight on at least like 50-60% of that at any given time. And so you feel like you have, unless there's a major shock like the one we lived through, you feel like you have plenty of visibility, and the lenders tend to like that.
Right. And at the time of the recap, I think it was a few days before COVID that it actually closed, but that was such a binary event that you would have closed without actually knowing the implications of what was just about to occur. And so to retrack what you were just saying there, so let's, for simplicity's sake, just imagine that you invested nothing up front, like most searchers don't invest meaningfully at the first close. So you had a 0% real equity stake. And then with carry, when you're in the money at 5x gross, you get, for traditional searchers, 25%, maybe 30% as a duo.
As a pair, we got 30. Yes.
Okay. So then you're in the money and effectively you own 30% of the business here, right? And so then you're saying, okay, how can we find a lender who's willing to give us enough incremental debt in order to take out at least 21%? So that, I guess it would have to be more actually, because your 30% has to pro rata increase to 51%. So
that's right. So if somebody is exiting, they sell
Yes.
100%, they get cash. Somebody else who's doing a partial liquidity event gets a combination of cash and units in the new vehicle. And so that's kind of how the math ends up working. And of course, as the GP, not only did we want to roll, but the lenders were saying, hey, we're only doing this if you guys are rolling 100% of your economics. So we had to eat last, so to speak, in order to make this all work.
What are the tax implications on carry when you have an event like that?
So it's a tax deferred event because you are crystallizing carry, but you do what's called a rollover election. And so I'm not sure how it works in the US, but in Canada, if you've got share consideration instead of cash, you can say to the Canadian authorities, hey, tax me when this eventually becomes liquid.
And what if things go south from there? Do you still have to pay those taxes in the future?
That's a good question. I hope to never find out. But I suspect if it turns out that it's worth less, then you probably pay tax on whatever your actual proceeds were upon liquidity.
But I suppose you would have a tax write-off with the subsequent period that is now negative then, if
Yeah.
that was the case.
Yeah.
Yeah, so probably some offset, if nothing else. Okay, yeah, thanks for walking through that. Earlier in the conversation, you mentioned, upon reflecting on Incursion Voyage, that you had certain MOIC drivers that were easily identifiable early on. What were they, in addition to the digital marketing that you discussed?
Yeah. So people, it starts with people. So I think one of the things that we did well at Incursion, because we were a relatively small business, and all searchers contend with this, you want to attract the best possible players you can to the team, and you have cost constraints. So that was one. And that underpins a lot of what we do today. So we'll come back to that. Two was having a very clear, if you think of like the business as cohorts or layer cake of cohorts, you got to have a very clear understanding of the cost of acquisition and the lifetime value of a customer. And that is true in B2C, but it's also true in B2B. And so this digital marketing pivot really forced us to hone in on what's a customer worth, how do we get them to repeat, and what's the customer acquisition cost. And if that's really accretive on the first purchase, then as long as they repeat, you have high NPS, you can spin that flywheel. The third is pricing. So we were able to move gross margins up quite significantly. And that's, you learn by trial and error. Like at first we thought price was a major driver of consumer behavior. And so we tried to play price down to see if we could scale volume, and we couldn't. It was a negative correlation, meaning that even though we picked up more volume, we didn't pick up enough incremental volume to offset the margin leakage. And so the following year we started to take price again, and learned through that experience that price is probably the most meaningful lever in any business. And it's uncomfortable. Like most operators will tell you, it's always, there's a bit of fear there. But when you have to add value in addition to the price that you take. But as long as you are adding value and delivering great service, customers tend to repeat. And then I would say being really thoughtful about, we call them, it's a terrible term, but we use post-mortem analysis. So we deal with every departure and we just tear it apart after the trip comes home, and we try to figure out what could we have done better operationally, but then where did we think the margin would land on this, and where did it actually land, and what was the driver, whether it was foreign exchange or, hey, you know what, we had a snafu on day 14 and we had to do something really nice to make the guests whole. All of those, we had to build a business process around measuring, tracking why we're outperforming or underperforming, and feeding that loop of knowledge back to the pricing engine at the front end. And in our business, it's like an 18-month cycle, because you have to release dates. Like right now, we're selling 2027 departures. As crazy as that sounds, like most of our bookings today are for fall of 2027. And so if you get it wrong, like you're gonna have to wait 18 months to learn what went wrong and then retool for 2029. So that's just the nature of that business. Those would be the major things. So how does that translate to other platforms, other businesses? I'd say one is having a clear understanding of what's the growth engine? So like, how do you acquire customers and what are they worth over time? So we spend a lot of time looking at, new customer acquisition, customer growth, upsell, downsell, if it's the type of business that lends itself well to that type of analysis. But how do you take a customer-led approach to building the layer cake of revenue that eventually transforms into cash flow? And so the highest quality assets have a very robust revenue quality, and that's something that's often espoused in search fund circles. The second is gross margin profile. So we had to do the heavy lifting of taking the margins from suboptimal to a pretty attractive place. certainly taking price is an easy lever, but there are businesses that out of the gates have really attractive margins. And so we try to understand what the drivers of those margin profiles are. And that tends to be a really important determining factor for us. And then we touched on people, but people is probably the number one area that we spend a lot of our time both diligencing, and it's often identifying gaps and helping the team fill those gaps. So if you'd like, we can go down, a bit of a rabbit hole there, but I think that's an area that's worth pursuing.
Before we go there, I have this completely unsubstantiated feeling that pricing is the most underutilized value lever in the lower middle market. What are your thoughts on that?
I 100% agree. And every founder of a business that you partner with is going to have a bit of tension around pricing, because there's relationship capital and customer fears, like what's going to happen when we announce a 4 or 5% price increase. But when you compound that over multiple years, it's truly magical what happens to EBITDA. It's transformational.
How do you know you can push it on pricing?
Well, like most things in life, you shouldn't go all in year one. I think a trickle and then a flow is probably the better approach to this. And so you start with a 2 to 3% increase or a 5% increase, something that tracks CPI or some other metric. Like we have a business that hasn't pushed price in 3 years, and we just recently got involved with it. And it has had 5 to 6% annual increases in vendor costs. And so when you can go to a customer and say, hey, look, we haven't moved price in 3 years, but here are all the vendor costs that we have absorbed and we just can't absorb anymore. That first movement on price breaks the seal, and then eventually you can get into an annual discussion at renewal around, hey, we need to move price a little bit here. We're just keeping track with rather than doing a bigger one every 3 years, we're doing a smaller one every year. And I have found that customers understand, but you also need to keep line of sight on what the value is that you're delivering to those customers, and as long as that value equation is in check and you're not moving yourself way off base in terms of where your price is relative to competitors, it's a very, very valuable tool.
Dan, you were just talking about B2B customers there, right?
Correct.
They're the ones who understand.
Yes.
Okay, but in a consumer context, I just let me be the voice of the consumer here. There's got to be some cost to raising prices, even if it's invisible. Do you not think it harms brand? I mean, we've all been on the receiving end of this, where your local plumber now charges 50% more, and maybe you pay it, but you're annoyed as a consumer, or worse. Is that just the kind of the cram down on the consumer comes cost free, or can it somehow deteriorate the brand over time, or do you just churn out the cheap customers and bring in the premium customers and it's all fine?
I often reflect on this churning out of customers. So first of all, we've never done like a 50% price increase, like, hey, private equity now owns this plumbing co, and so therefore we're just going to take price to that extreme. I think you're going to alienate a lot of customers. Now you could do that over time. It could be like 5 to 8% every year, and if you compound that, you can end up at 50%. And if you're long-term greedy about it, maybe it's just a frog in boiling water. They don't notice it as much, right? I would tell you that in our group tour business, we are not the cheapest offering. And some of them are a lot cheaper, like by thousands of dollars per person. And what we deliver instead is a unique selling proposition, because our whole pitch to the customer is we're radically all-inclusive. We send a town car or limo service to the home to pick them up. We include the travel insurance. We include the flights. We include the tips. Like, we joke about it, but in theory, you could leave your wallet at home and go on one of our tours. And so there's a customer who says, no, I'm going to decide how much I'm going to tip, or no, I'll get my brother-in-law to drive me to the airport, or all those decision points. And that's not the type of customer that we attract. That said, on our tours, there's every 3 days, there's a half a day that's at your discretion. Like, you can spend it doing whatever you wish. And we have a bunch of optional excursions on those days, because some people want to chill and some people want to maximize, hey, I'm on the ground, I want to see it all. And what makes us different in the radical all-inclusivity is that we never charge or upcharge for those experiences. So you can wake up that day and say, hey, yeah, I'm going to do the walking tour. I'm going to go take that gondola ride up to the top of the mountain. We don't nickel and dime our customers, and there's a value-based pricing for that. And so I think, to answer your question, you need to be thoughtful about how it lands vis-a-vis the customer, because if it's just an hourly rate and you're charging more because you can, yeah, it feels extortionist. But if you're delivering this uniquely positioned value prop, I think there's a lineup of customers willing to pay, and the growth that we're seeing in that dynamic is quite attractive.
Dan, another question on consumer businesses. So we've had a number of conversations separately this week about this here at Minds Capital. And consumer businesses, as we know, are usually disfavored by private equity. You went through all of the great characteristics of travel businesses, travel tour businesses. And so you were, willing to look at the nuances of the business as opposed to just broad brush discounting consumer overall. That said, you ultimately did get bitten by the consumer nature of this business. Granted, it was a black swan event in the form of COVID, but it completely decimated the consumer demand for this. This is a discretionary, almost luxury spend. So reflecting back now, do you, despite the fact that you went forward with a consumer business and have done really well with it, but you also felt the pain of being in a discretionary consumer business, would you do things differently? Would you advise some other searcher or sponsor out there looking at a consumer business to not go that path? How do you reflect?
Yeah, I think so we had looked at 9/11, great financial crisis, as the two prior crises that had hit travel. And travel has this cycle of, something really bad happens.
Yeah.
And 9/11, in our due diligence up front, had been the worst event because people were scared of flying. And these businesses had done quite well. Sure, there was like a 1-year lag and it was like a softer year. But then after that, it comes roaring back. And if you'll believe it or not, like the businesses, we now own 4 of them, but like these businesses in the global financial crisis actually grew through the cycle because people who've already retired have made their money in life, have paid off their homes or cottages or whatever else that they've got going on. The kids are out of the house. And so the number one discretionary spend is travel. And so I think the big lesson that was implicit in that choice was we were targeting a customer demographic and a spend bucket that was quite recession resistant. And so it took, and by the way, we focused on outbound travel, meaning we originate customers in Canada and now the US and send them all over the world. And the thesis there was, okay, if there's a terror attempt, God forbid, or a crisis somewhere, or a war, or like a health scare, demand shifts from one destination to another. People don't stop traveling.
Yeah.
So COVID was this really weird black swan event in the sense that it literally restricted all outbound travel anywhere. Doesn't matter where it is. And so our hedge, if you will, in terms of the dispersion of destinations, couldn't help us in that scenario. I think when I zoom out and think about consumer businesses, the main fuel that you need to fuel growth is your customer acquisition engine. And so it comes back to this fundamental analysis of the unit economics. How much do I have to spend to acquire a customer, and is that profitable? And in the travel space, the gross profit pool on the first purchase is significant enough that your customer acquisition cost, you get the return economics on the first purchase. You don't need this LTV to CAC formula to talk your VCs into the spend level. Like if you've got a business that on a value basis, it's got really attractive fundamentals, that's what I would encourage searchers or independent sponsors to look at is how confident am I that I can scale the spend and acquire customers profitably? And if there's a path to customer acquisition that's profitable and fueling profitable growth, I think it's no different from B2B in terms of behavioral sets. You need to be thoughtful about what's the segment, what's the spend bucket, and is it truly discretionary, or how do people behave when they need to tighten the belt?
And so going back to the target company, you recapped that you're now an independent sponsor. You are still in the deal, but I believe you had yet another recap along the right way, right?
Yes. So the recap was in 2020, and we did a second recap in the summer of 25. So again, travel had recovered. 24 was really our first full year back. And so the timing was right to kind of revisit the debt package. We had a 5-year term on it. And so the lenders had seen us fight tooth and nail during the crisis, and had seen the behavioral elements and the trust building that came through that was quite substantial. And so there was a lot of appetite at the lender. Same lender drove the recap, the second recap. They weren't rushing for the exits. They were quite happy to finance it.
Did you exchange any shareholders at this time?
So more people got off the bus. Today, like, we've increased our ownership stake substantially through that recap, but we rolled our economics again.
Did the lender require that the second time too, that you rolled the entire 100%
I don't
of your
remember
carry?
if it was a condition, but we believe in the business and we want to own it for a while longer. And so we didn't really ask, hey, how much can we take out? We just kind of said, hey, we want to own as much of this as we can. So it was baked into the premise, but it wasn't a requirement this time around.
What is your threshold for selling the asset altogether?
We will. At some point, we will sell it. I think that the nature of this business is one in which we've got this flywheel going. And so as it scales, we need to, there's a timing disconnect. So we invest dollars today to generate a booking sometime over the next 6 to 12 months, which is going to convert to revenue another 12 to 18 months later. So there's this long lead time if you think about the cycle. And so we're deliberately investing, and we're in the investment phase now to fuel growth for 28, 29. And so there will come a time where that ascent normalizes. And when that happens, the cash flows will catch up to the revenue profile. And I think it'll make more sense to consider an exit at that time. But for the time being, we're perfectly happy with the return on capital.
And so 2020 marks this demarcation point for you to become an independent sponsor. And since then, can you tell us a little bit about how many deals you've looked at, what your deal funnel typically looks like, and what your cadence has been in terms of doing new platforms?
Yeah, so we basically went from a standing start, much like all independent sponsors who launch. You put your shingle up there and you say, hey, I'm in this business and I'd like to take a look at deal flow. And so we took a very specific approach to origination. We hired a full-time BD professional. His name is Adam, and he runs all of our upper funnel origination activities. So that looks like doing monthly check-ins with tier 1 advisors, so people who show us quite a bit of deal flow, doing quarterly in-person visits with them, all the way down to maybe semi-annual checks with the 1 or 2 person shop in a remote location that might have a deal or 2 a year to show us. And so the first year we didn't originate all that much volume, but we were just getting the engine started and building the relationship book, and we set out to track all of it in a CRM and all the things that most independent sponsors do. But over time, we've looked at north of probably 3,500 deals at this point. We look at about 700 deals a year. 750 was the last year. That is everything that gets logged into our CRM. There's obviously a bunch of lists and other random opportunities that pop in that we don't even populate into the tool or system. And out of those, I'd say we execute an NDA 60% of the time, something like that. So we're looking for any reason to not go through the business process of negotiating the terms of the NDA and turning that and the time spent there. And so out of the remaining deals, we take a pretty hard look at those on a weekly basis as a team. And we're looking for any reason to pass so that we're really focusing our time and energy on the ones that we think would be neatly within, our buy box. And so in practice, it looks like 15 to 20 deals a year that we're meeting with management, doing more intensive due diligence. And then out of those, there's probably 2 to 3 LOIs in a year. And these are platform statistics. There's also add-on stats that we track separately. And so if we're submitting 2 LOIs, we usually feel pretty good that we're going to be able to win at least one of them and close that deal that year. So over the last, it's gonna be 6 years in the fall that we started, but basically over the last 5 years, we've done 5 platform acquisitions, and we've now done 3 add-ons, in addition to 1 add-on for the original platform over the last 5 years as well. So it's been an active little while. We don't have ambitions to be the biggest. We just want to pick off quality businesses where we can deploy our playbook and run it. And that playbook is different from one asset to another, but we're really excited to partner with great teams and build businesses together.
Can you tell me a little bit more about your BD professional who you hired 5-6 years ago? What is the profile of a very good BD professional? How would you structure their comp? Maybe you don't want to share the comp of your particular employee, but is it very cash heavy or is it more carry loaded? And if carry heavy, what does that actually mean for such a resource? Can you share some more about that?
Yeah, so I think the hardest part about originating is showing up with a smile day in and day out and doing the hard work daily, weekly, monthly, quarterly, even when you don't feel like it. So I'd say temperament is the most important feature. Temperament and discipline. And so Adam on our team has tremendous discipline. He uses a tool to help him schedule his tasks. And so when he knows it's been a while that he hasn't checked in with Nick or Will, he'll get a pop-up reminder in his task reminder, and he'll either initiate a sequence, which will be like an email outreach or a text outreach or something like that, or he'll find a reason to schedule a meeting and build some other meetings around that in-person meeting. It takes a certain type of person to want to do that and fill their calendar with calls and meetings like that. I mean, in a normal week, he'll do anywhere between 30 and 50 calls or meetings. So that's like an Energizer Bunny type of human being, and that's his superpower. He also needs to be able to translate the features or characteristics about the businesses that we're looking for into questions, so that when he's getting a teaser, he can take off the investment team's plates, some of the very, very preliminary questions, like things like customer concentration, the nature of the revenue. Is it one time and project based, or is it more reoccurring? There's like a number of I'll call them fatal flaws, or things that we look for early to figure out, okay, we shouldn't spend time on this. And he's got to be a relationship builder. Because at the end of the day, this isn't like real estate where there's an MLS type system where everything gets published. They don't have to show you their deals. And I'm sure that despite there being many independent sponsors out there, there's probably a lot of deals that don't get broadly shopped that not everybody sees. And so I would say that's a big component of it. I'd say in the first year or two, so we tilted cash comp heavy at first. And so it's a base and a deal completion bonus. And so he's got an incentive to find deals that are going to close. And that's where we tilted the compensation structure. And then over time, he's earned his way into earning carry in the fund or in the vehicles that we have. So there's co-invest rights as well and things of that nature. So I think it's about, you don't want to do that prematurely. You want to make sure this is someone that you trust and want to be engaged with and entangled with for many years to come. And that's certainly the case with Adam.
Does it vest when he gets a carry?
So there's 2 kinds of long-term incentive. There's like the investment, co-invest dollars. That's on the same basis as everybody else. Right. And then the carry is based on, some retention mechanisms.
Would a BD person be the first hire you should do as an independent sponsor?
So we did 2 pretty close back to back. So we did the origination professional, and then we hired an execution professional as well. So this is someone with former investment banking experience to help with modeling, tearing through the data room. We do a lot of the commercial due diligence ourselves, customer calls and the like. And so it's a heavy lift when we're looking at a deal. And so we wanted to have an extra pair of hands that's capable. And so same kind of MO there. You need someone who's thoughtful, investor in training, very similar to like an associate role at a smaller, lower mid-market fund.
That strikes me as the first place to start for most independent sponsors. They just need, you have 750 deals you're looking at. We just need an extra set of eyes who can help us process all of the work.
You got to get the 750 deals first.
Yeah, exactly.
So it's a question of like division of labor. Who do you give what to?
And what is the link between being institutionalized around originating and returns on the other side of the spectrum?
Yeah, we think about this a lot. I think back to our search days, and when we were live on a deal, you stop originating because it's all encompassing. So as a deal person, you just want to focus on the deal. And then when the deal falls apart, your pipeline's feeling pretty scarce. And I never liked that experience in the search phase. And so a big part of the rationale for having a full-time origination function is that there's a constant stream of deals coming our way. Every month, there's 50 to 60 deals that we're going to look at, most of which we're going to say no to. And knowing that there's another 50 or 60 deals around the corner, and if it isn't this one, it could be the next one, is a powerful mindset shifter. Because if the numbers start to slide or the seller starts to behave in like, I'll call it yellow flag sort of ways during the process, or negotiating tactics, or whatever it is, knowing that you've got plenty of deal flow right around the corner helps you walk. And otherwise, you might be tempted into hanging around the hoop for the wrong opportunity, or executing. The worst thing you could do is do a bad deal just because you have deal fever. And so I'd say we view it as a source of discipline, and hopefully a source of IRR or MOIC in the long run.
Dan, shifting gears a little bit, in the pre-call, we talked about one difference in Canadian opportunities versus U.S. opportunities is the use of holdbacks in Canada, the rather common use, at least at this end of the market, where you just don't see that in the U.S. This audience will probably know the mechanic, but just walk us through it and how appealing it is for you as a buyer, and why it makes doing deals in Canada a little bit more palatable than down here.
Yeah, and I would preface my answer by saying that it's not that it's unique to Canada. I think you can certainly find deals in the US with holdbacks in them, but I think the competition is fiercer in the US. And so the seller's appetite to accepting that kind of arrangement is lower. But notionally, you have three ways of protecting your interests in terms of the reps and warranties, or the promises that a seller makes to you at the closing. And it took me a while to understand this, but it doesn't matter what's in the VDR or in the data room. All that matters is what the seller promised in that purchase agreement. Because that's, if you have a problem and you need to litigate it, it's the reps and warranties and the disclosure schedules. That's all that matters. That's all you're going to rest on. And the indemnification process for if there's a breach of those reps is usually one of three things. You either have taken out a reps and warranty insurance policy, for which the premiums are expensive and they tend to be deployed on larger opportunities. Two, which is very common if you're not going to place a reps and warranty policy, is to have an escrow. And so basically what that is there's a percentage of the purchase price that's set aside in a fund. It's funded at closing, but it's set aside in a separate bank account. It's restricted, and it sits there earning kind of, CD type of interest until such time as the rep and warranty window has ended. And once that tail is ended, then it gets released to the seller. Or if you have a claim, you can tap into that cash reserve right away. The third mechanism that we like to use is a holdback. And a holdback means that you're issuing a note, a promissory note to the seller. It's subordinated to the debt instrument. And the seller is not going to get the money at closing, much like an escrow. But as a buyer, you don't have to fund that cash to the balance sheet upfront. And so it reduces your equity requirement. Now, it adds leverage to the system, right? So when you look at total debt to EBITDA or total debt to TEV, you need to factor that in so that you're not over-levered as a result of the deal. Because at some point, you need to make good on that obligation. But that's something that we've been able to deploy on even larger transactions in Canada. And I don't think that would fly in the US. So that was kind of the nature of my comment. But it comes down to fit, right? These are dislocations when an independent sponsor is getting involved. I don't think the typical independent sponsor is winning a jump ball auction process, and getting away with structure or whatever. It's usually going to be a unique situation, a unique look, and to make that deal happen, one of the things is going to be a feature that you push for, and that's one feature that we often push for.
Yeah, I don't know. We call them seller notes, of course. I don't know that they're uncommon in the United States, but I do agree that Canadians or international sponsors have a higher proclivity for being creative with their financing. And I think it is because the capital markets are less institutionalized and mature. And so then going more aggressive on the seller is one way to close the gap of the cash you need to get the closing.
This would be a forgivable seller note as opposed to just a straight seller note.
Yeah, it's not straight financing. We can do that also. Like some deals, we do have seller notes just to close the financing gap. But especially in Canada, the commercial lenders are so accustomed to lending on cash flow deals in the lower mid-market that debt financing is quite abundant in Canada.
Okay, yeah, thanks for clarifying. That's what I call a reverse earnout, where it's contingent not on growing or improving performance or baking in future or imminent growth, but on not declining, so to speak, right? And so you promise to pay it as long as nothing bad happens in the near term.
Yeah.
Then you mentioned how you hired 2 people initially, one to be in business development to find the deals and another one to help you execute the deals that he originates. What else have you done on the team side as you've built it out?
Great question that we really had to put money where our mouth was on the people front. So one of the realizations was that we were spending a lot of our time interviewing, originating, pulling relationships to find candidates. And so one of the early hires that we made was a talent acquisition professional. This is a full-time resource that exclusively dedicates her time to finding great, talented people for our portfolio. The advantage is that if you don't need her time or effort, you don't use her as the CEO of a company. And if you need to hire 6 people in 8 weeks and she's available, you can have her full time for those 8 weeks. And it removes a lot of the impediments that are often found with hiring managers on making moves on HR situations. And so her time to fill, because she's dedicated, is like 31 days from the time we post a job opportunity and we fill the seat. She's filled close to 100 roles over the last 3 years. So that's been tremendous help to the executives. And it takes a little bit of time. Like the CEOs individually each have their own hiring style, or if it's a hiring manager, you got to find your groove. But after a couple of, searches, they tend to become quite accustomed to working together, and there's a desire to continue working together. So that's been a tremendous help for the portfolio. And then, and by the way, all of these businesses at all times have people challenges. And so whether that's rounding out a team or we're growing in a new market, we need to add headcount. We're constantly, there's always something on the go on the people front. So it has not been an issue of like keeping her busy.
So just like you're saying on the deal front, you can always walk away from a deal since your BD guy is drumming up new deals. I'm joking.
Yes, but you can walk away from a talent situation where you're desperate or you don't have as many candidates in the pool. It keeps the bar higher. She also has developed some tactics around, like I'll call it sniping, but just working through LinkedIn to find the type of talent that's not actively searching or applying for a job. And we've had success from pretty entry-level roles all the way up to like executive ranks. So that's been a great addition to the team. Similarly,
does she charge back to the? Do you charge her back to the companies then when you do an actual recruiting?
We do, and we do it at cost. And this is like a fairness principle, but we have SPVs for each investment, and there are different investors in each of the SPVs. So we're very mindful about not creating profit pools to the benefit of some or to the expense of others. So we just charge her back at cost with a view of it being fair to everybody at all times, and it's really a benefit for the portfolio.
But you need some critical mass in order for this to make sense, to have a recruiter on staff. What is that juncture?
For us, it was after the third platform and realizing how much time we were spending on recruiting or helping the executive teams recruit, or frustration around, hey, how come we're not moving faster on making moves on the HR front? And so there was a bit of a leap of faith. But after we had reached 4 platforms, including the travel business, it made sense to make a move for it. So I wouldn't advocate this being one of your first hires, but we spend a lot of our time on people, and we're big proponents of the Who method. So all of our CEOs get the book, and we use that method for the recruiting and interview process, and so that was a really important hire for us. And then the other area that I suspect a lot of the independent sponsors struggle with is, founders typically underinvest in their finance functions. And so we're constantly having to build additional people, technology stack, and information quality enhancements within each of the businesses that we invest in. And we assume we're going to have to do it. And if we're surprised to the upside, great. But usually in diligence, you uncover some limitations. And so one of the realizations we had is that as deal partners, we were playing CFO. And it's not a very good use of our bandwidth and energy when you're checking the notes to the financial statements, or thinking about a hedging program, or things that are a bit above the capability set of a controller or director of finance level hire, which, by the way, we've done in every single platform. And so it made sense pretty quickly thereafter to hire a CFO full time, and he's fractional across the portfolio. So he spends, call it like a day a week with each company, and that's been quite accretive in terms of thinking about risks that we don't think about, helping us manage those risks, and also enhancing the quality of the information that we're getting in our monthly financial review process. So that's been tremendous in terms of taking stuff off Leroy and my plate, but also in improving the quality of the information we get. And then
charge him back as well?
Yeah, it's all part of the management fee stream. So if the company is paying us a management fee, part of that goes to cover JP's
No, but I mean,
time.
if he spends a day a week with a portco, do they cover 20% of his salary?
Yes. Yeah. That's basically how it works. And so
Yes.
it's reasonable for none of these companies can justify having a CFO full time, but a day a week, like that cost sharing arrangement, seems to strike the right balance between the value they're getting and the insights and the cost for getting that.
I love the idea of centralized resources like this, right? Very efficient, and you can attract better talent when you can deploy them across a portfolio. However, what implications does this have downstream when you're looking to exit, that they don't actually have a full-time CFO, or that they've been relying on a recruiter that isn't part of the organization?
Yeah. So let's take the recruiter example, and then we'll circle back to the CFO example. There is a cost in the P&L for each role. And so I think it's a very attractive cost per fill, but you could easily normalize this for working with fractional talent acquisition professional, of which there are many out there nowadays. And I think the same is true for the CFO role. If you said, look, we've been running this business for 4 years with a fractional CFO to the tune of this much. Here's 4 other fractional CFO practices out there, of which there are many. And I think it becomes a valuation discussion around a Q of E process. But that's kind of how we think about it. We're careful about not merging, for instance, in the benefits and health insurance sphere, merging all of the companies into the same pool, because then it becomes really hard to tear one company out of that pool from the experience ratio analysis. So I think you have to be thoughtful about when to do it and when not to do it. But for discrete talent impulses like this, I think it makes a lot of sense. I'd be remiss if I didn't mention Sarah. Sarah helps basically catch all the falling balls, stuff that's slipping through the cracks. She is like a super EA for us. She handles all of the scheduling, travel, manages inboxes, makes sure that the bookkeeping, chasing down K1s, all this kind of stuff. Without her, we'd be in a whole lot of trouble. So really grateful for her contributions.
If you look ahead, who will be your next 1, 2, or 3 hires at the Snowdon Holdco level?
We have 2 hires on deck. One is going to be another investment professional. We did 2 deals in late August and first week of September, so basically around the same time. And Alex on our team, had dinner at the office every night and almost didn't sleep for a good month straight. So rather than having to choose which deal we want to do, we'd like to have the capacity to do 2 deals at once. So that's likely a role that we will fill in the next few months, or maybe early 27. And then there's another role that we're seriously considering, which is a business building role. So if you look at like our calendars today, when we started, we were doing a lot of origination, a lot of execution, and a lot of portfolio management. So if you will, it was like a third. By having a full-time origination person, our origination time has reduced as partners from, call it, a third of our time to probably like 10% of our time. You don't turn it off completely because you need to keep certain relationships alive, but I've reduced the amount of time I need to spend on that. Likewise, on execution, as Alex has learned how to do lower mid-market buyout, he's been able to take on more and more as part of the deal. So whenever he's on a deal, it's either with Leroy or myself. It's a 2-person deal team. It's quite lean, but he can handle a lot more than he was in his first year. And so that's reduced the reliance on us as deal principals to be doing analysis and building Excel sheets, right? The one area where we've not taken anything off our plate is on the business building end. And so that's taking up more and more of our time, and it should, because we believe in being all in on fewer companies. But there's an area where we could bring on a talented business builder or value creation person. And we're still working through what that looks like, because we don't love the operating partner model. And we don't love the external consulting firm model. So we're still tinkering with what that's going to look like. But it's mostly to emulate the fact that when we only had 1 or 2 portfolio companies, if the CEO had a lot on his or her plate, we would say, hey, why don't you let me take that on? There's just less time available for me to take stuff on. And so I'd like to have some bandwidth to be able to execute against some of those things. And when it makes sense for the GP to be doing that.
Is that when you can extract yourself from operations and you got all the bases covered?
I don't think you can ever extract yourself from operations. This is not a set it and forget it type of business. It's a very hands-on at all times. It's more about augmenting. And it's kind of like AI, right? Like, it's not like you're not going to do full-time work. You're just going to be able to get more done in the hours that you have. And so I think of it as like building out the team sequentially as the platform scales. And the nature of my days is going to change, but I'm still young and still got a ton of energy and work pretty hard. And so I don't want to slow down. I just want to be able to keep up the pace and the momentum.
And on that note, your ambition is not to be top quartile, right?
I mean, every firm should have that ambition, and we certainly have that ambition. And I guess we'd like to be even better than that if we're fortunate enough to make that happen. And so we're playing the game to win, and it's not about being the biggest. For us, it's a very strong performance bias.
And I'm pulling your leg a little bit here, but specifically you said that your goal is that Snowdon becomes known to be a top decile performer. And it was jarring to hear that, because you always hear top quartile is kind of like what your ear is used to hearing. And so hearing top decile was just intriguing. And so what would you say is the difference between top quartile and top decile?
It's a very mathematical inference, so I won't get into the statistical anomalies there, but I guess the best way to say it is, if you're an athlete and you're playing a sport, you're playing the sport to win. And, certainly if you're an Olympian, you want to be on the podium. Everybody's chasing gold, but you at least want to make the podium. So qualifying for the national team is an exciting place to be, and we certainly want to be on a national team. And we're fighting every day to earn our right to be on a national team, but we're chasing a medal. And so I think that's the spirit of that comment is we do this because we want to be doing great work and we want to be known for that. And, that's what kind of fuels our ambition and our drive.
Yeah, I like that. It's not about being one of the best, but you're striving for exceptionalism and excellence in what you do. And that in itself becomes a motivator for you as an operator and business builder.
Yeah, and I think private equity has gone through this era where, AUM aggregation is the name of the game in a lot of the funds that are out there, and it makes a ton of sense. But we're on the opposite end of that spectrum. We're not about scale or AUM. It's really about performance bias.
Let's end it on that, Dan. Great way to send us out. Thank you for your time. Thanks for coming on the Minds Capital podcast. Dan Chetrit of Snowdon Partners.
Thank you so much, guys. This was a ton of fun.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.